Greetings from Istanbul, sentient bipedal hominids. This is Atilla Yeşilara, dropping another video for Real Turkey channel. Today we're going to talk about Turkey's raging and outrageous inflation. It was 6.5% in January. That's for the month, not for the whole year. Okay, for the whole year, Turkish CPI, Consumer Price Index, rose by 65% or 66%. Does it really matter? When the handle is 60, does the 5 or 6 matter? And of course, this raging inflation raises the question of whether Mehmet Simsek's austerity program, economic stabilization program, is in jeopardy. Is he a failure? Will he be replaced? If you look at my last video, Gaye Erkan, the central bank governess, was under fire for allegations not related to her performance as central bank chief, but she was sacked, or she resigned and then she was sacked. We don't know. We'll never know. This is Turkey. There is no transparency. But her departure is a painful reminder that Mr. Erdogan can dispose of people like I dispose of toilet paper. Okay? So, several questions. A, where is inflation going? B, is it Mehmet Simsek's fault? C, is there any success in this economic austerity program that has been now in progress for over 6 months, 7 months? And finally, what does Mr. Erdogan think? Because at the end, it doesn't really matter whether Mehmet Simsek is successful or not by any objective criteria, except in Mr. Erdogan's mind. Turkish inflation, 6.5% at CPI level. Main reason, at the turn of the year, Turkey has this automatic statutory minimum wage increases, which are also almost entirely reflected to pensions, civil service salaries. More or less, when the minimum wage is raised, the entire nominal income level of the economy rises by as much. And this year's minimum wage hike was 50% per year. I think over the last 12 months, minimum wages increased by over 100%. Clearly, this is inflationary. It's particularly inflationary in Turkish environment because people want to spend the money immediately, because they know if they keep it in their bank accounts or in their wallets next month, its purchasing power will decline. So there has been a very rapid pass-through from these wage and salary hikes to final price hikes. And it will get worse. The economists I trust tell me that this year's CPI will peak at around 70%, and at the end of the year, it's very unlikely to fall below 50%. By any measure, an economic stabilization program that primarily targets lower inflation has been a failure. Is it Mehmet Simsek's failure? To answer that question clearly, we need to understand that economy ministers or any minister in Turkey does not have much agency. He's actually an employee, an underling, a lieutenant of the president. This is also in the United States. I mean, Secretary of Treasury, Ms. Janet Yellen, is there because President Biden wants to work with her, and at the end, Biden is responsible. Biden tells Yellen in what framework to operate, though, of course, she has more independence than Mehmet Simsek. In Turkey, too, we got to ask the question of how much authority has been given to Mehmet Simsek to pursue an austerity program. We never know because there has been no formal communication between the president and the economy czar, but we know that it wasn't much. For instance, everyone knew that the current monetary, central bank policy rate was insufficient to have any serious impact on inflation, but because we have local elections at the end of March, that was the end of the limit for Mr. Erdogan. Also, even though the official title of Mr. Mehmet Simsek is Finance and Treasury Minister, is really not in charge of the budget. Turkey's budget deficit was over 6% of GDP as of 2023, but roughly half of that went to earthquake reparation expenditures. So the portion that was under Mehmet Simsek's control closed with a deficit of less than 3% of GDP, which was a success. Of course, I admit that budget restraint was secured not by spending restraint, but by tax hikes, which were also inflationary, but nevertheless, it was done. I think one aspect of economic policy that has succeeded, but that has flown under the radar, went undetected by a lot of economics commentators, is that the secondary objective of this economic stabilization program is to reduce the current account deficit, or Turkey's external deficit, to a sustainable level, which is probably 3 to 3.5% of GDP. There too, the mission accomplished statement is too early, but there has been significant signs that the external deficits are declining and that Turkey, to use an economics term, is rebalancing. That is, growth is slowing down and shifting from domestic consumption to exports. What evidence do I have to suggest that? Well, we look at PMI numbers as everyone else. In Turkey, the manufacturing PMI is largely conducted among exporting large industrial companies, and that began increasing on a month-on-month basis in January. So yeah, I think in that sense, we can see exports increasing despite the poor conditions of the economy in Europe, which is Turkey's primary customer. Secondly, we also have a composite PMI conducted by Müsiat, a business people's association called SAMEX or PUMAX in English, which shows that the activity in the services sector is declining, and usually services make a much greater contribution to inflation than manufacturing. So in that sense, the decline in services activity is another sign that domestic demand is cooling. Of course, also the private measurement of consumer confidence by Bloomberg HT, no relation to Bloomberg, no relation, just licensed by Bloomberg, but completely different concept. That consumer confidence index declined by 5 percentage points at the end of January, which also shows that even though they have more money, Turkish consumers are probably becoming more mindful of the future and, saving a little bit more. And of course, finally, Turkish trade deficits have declined sharply, first in December, then in preliminary January data. Again, economists use novel concepts to explain very old ideas so that no one understands them and they can keep their jobs. But in terms of assessing how domestic demand is progressing, we look at core deficit, which is trade deficit less gold imports, less energy imports. What's left is, of course, what people demand to buy from abroad. And that has turned into a monthly surplus as of January. So in that sense, rebalancing is going very well, which means that one of the reasons for high inflation is being eliminated. Now remember, in the United States or in UK, the value of the local currency, US dollar or the sterling, doesn't really make much of a difference to the domestic price level, but that's untrue for most of the developing economies. Well, maybe China is an exception too. But in most developing countries, if your local currency depreciates, that passes through to final prices because you import a lot of stuff from abroad and inflation increases. So to the extent Mehmet Simsek is successful in reducing current account deficits, there is an indirect contribution to taming inflation. And on that account, I think he's very successful. Financing of the current account deficits has improved. The final official data, the balance of payment statistics, are from November, so they are not much used to explain the conditions today, but I speculate that after a 5-year hiatus, whatever, Turkish private sector began increasing its external loans. Now, when a country, private sector, reduces its borrowing from the rest of the world, The difference is paid either from their dollar savings or from the reserves of the central bank. The fact that Turkey is now borrowing more than it pays off in terms of maturing loans and bonds means there is more currency flowing in. And the longer term the borrowing, the better it is for sustainability. I mean, if all the money coming into a country from abroad is to the stock exchange or, to the money market, it can flee the next day when circumstances change. A lot of the money coming to Turkey to finance the current account deficits is in terms of one-year syndicated loans advanced by major global commercial banks to their Turkish counterparts. But we're also seeing private sector issuing more 3 to 5 year bonds, which is very positive development for sustainability. And I think these developments are sustainable. Even though Turkish lira is appreciating in real terms, the central bank and the banking watchdog, BRSA, have imposed or shall impose significant measures to make sure that this buoyant domestic demand doesn't pass through or seep into imports. In other words, the connection between people making more money and people importing more consumption goods will be severed by one way or the other. So there, Mehmet Simsek is successful. He has attracted some hot money, financial flows into Turkey, $4.5 billion. That's successful. Also, Erdogan must know, or would know, I would assume, that a lot of big investors, huge investors, have said that if Mehmet Simsek stays in power after the local elections and is allowed to pursue a stricter stabilization program, they're willing to invest into Turkey. Why should Erdogan know? Well, I wasn't there, but JP Morgan had a major client conference with Guy Erkan, the former central bank chief, and Mehmet Simsek also participated online. And that meeting apparently went very well. Public as well as private commentary I'm privy to said exactly what I've said, which is that you're on the right track. We're not yet convinced. What you're proposing as a plan to reduce inflation and current accounts deficit sounds plausible, but we don't know whether Erdogan will stick with you all the way. So, from Erdogan's perspective too, Mehmet Simsek is doing whatever he can. Does that mean he will stay in power and be allowed or be given enough authority to pursue a real stabilization, a real belt-tightening program? That depends to a large extent on the results of the local elections, on which Last Chance for Turkish Democracy is the video I shared with you. You can take a look at it. If Erdogan wins back two major cities, Ankara and Istanbul, then yeah, I think Mehmet Simsek will stay in his post. And since Mr. Erdogan won't have more elections to contend with in the next pursuing 4 years, he will be more lenient or more liberal in terms of telling Mehmet Simsek, look, the economy is yours, do whatever you do. I know it's going to be painful, but make sure that like a year before the next elections, I have strong growth with low inflation. And I think that's a mandate that Mehmet Simsek can deliver on. Of course, if Erdogan loses big, which is defined as losing Istanbul and Ankara, that's not Mehmet Simsek's fault. But usually in situations like that, well, politicians in Western countries resign. In Turkey, they look for scapegoats, and the most likely scapegoat is Mehmet Simsek, because a lot of the AKP constituency still believes that the best way to cure inflation is by lowering interest rates. Don't ask me why. That's how it is. Don't ask, don't tell. So Mehmet Simsek's post is fairly safe, I believe. Last question, let's talk about Fatih Karahan, just sort of, close loose ends from my last video. As I've said, Guy Erkan resigned to protect her family against allegations of nepotism and mobbing at the workplace. And a few hours later, she was dismissed by the president by an official decree. I don't know what the truth is not relevant. The new person, Fatih Karahan, the deputy governor, has studied in the United States, has a PhD in economics from a prestigious East Coast University, Pennsylvania, either Pittsburgh or University of Pennsylvania. He worked at the Fed for 11 years, and his last posting was as senior economist to Amazon. He also had teaching jobs at Columbia and another university. So a man with a great career, young, he's in his 40s. He is also believed to have good relations to AKP frontbenchers. All of these makes him qualified to do the job well. Why is it important to have good relations with, major names in AKP? Well, you got to be able to persuade them that monetary policy needs to be made tighter and it's going to cause some pain to their constituencies. Gaye Erkan was always an outsider. I don't know if she tried, but I'm fairly sure even if she tried to explain monetary policy to Erdogan, she would have been dismissed offhand. Now, Fatih Karacan may have more of a luck when it comes to that. Fatih Karacan will need to raise interest rates after the elections. In several of my videos, I touched on that subject. I said, even though it is a success to persuade Erdogan to raise the central bank policy rate from 8.5% to 45%, and that looks like a draconian increase, it's not enough. If you want to deal with 65% inflation in a country where no one believes the official figure, people believe it's something like 100%, and expectations are extremely sticky, you got to be able to raise, or you should raise the interest rates to at least the level of the current inflation to make sure people stay in Turkish lira and to make sure people save rather than spend. So, again, until the elections, there is not much Fatih Karahan can do on the interest rate front. I think rates are set until after the elections. But now a lot of investment banks who were only a month ago discussing the timing of the first rate cut are talking about rate increase. And that's where I am. I think Turkish monetary policy will have to be tightened significantly, just like the Fed says, longer for higher. Fatih Karahan can immediately enhance his credibility by doing the other stuff that central banks do and that that are not noticed in Western countries. One of them is to cooperate with the banking watchdog, BRSA, to tighten lending standards to credit cards. For instance, reduce the installment numbers, reduce the items to which credit cards can be used, increase the capital requirements for credit card receivables of banks, to raise the required reserve ratio, to use money market operations more effectively to absorb excess liquidity sloshing in the market. All of these will only help at the margin. I mean, when you have an inflation tsunami, lifeboats or lifesavers are probably not enough, but psychologically they will boost investor confidence because most investors know that at this time interest rate policy is set in stone. But by doing other things, Fatih Karahan actually proves that he is not gearing monetary policy to help Erdogan win elections. In fact, it's exactly the opposite. He is doing as much as he can to keep monetary policy tight while Mr. Erdogan spends lavishly on voters to win the election. Thank you very much. I want to thank again to Mesele Economy, which co-produced this video. And I'm really, really grateful for your comments. Please comment and share with your friends or whoever might be interested in Turkey. This is Atilla Yeşilada saying goodbye from Real Turkey Channel.